Chapter 13, Cost, Accounting, and Reporting. After studying this chapter, you should be able to explain the role of cost accounting as it relates to both financial and managerial accounting. Describe how cost management plays a strategic role in an organization's value chain. Contrast direct and indirect costs and illustrate how they relate to a product or activity. Distinguish between product costs and period costs and identify the three components of product costs. Explain the general operation of a product costing system and illustrate how costs flow through the inventory account to cost of goods sold. Calculate predetermined overhead application rates and demonstrate how they're used. Prepare and interpret a statement of cost of goods manufactured. And explain and illustrate the difference between absorption and direct or variable costing. And perform activity-based costing and describe the basics of activity-based management. In financial accounting, the focus is on external reporting. In managerial accounting, the focus is on internal reporting. In cost accounting, the focus is on cost accumulation and assignment, providing information internally for managers, but also externally for investors, creditors, and others that use the financial information in the financial accounting reports. In financial accounting, our focus was on the financial statement costs. However, costs for cost accounting purposes refer to product costs. In financial accounting, cost is a measure of resource used or given up to achieve a stated purpose. And in managerial accounting, costs are assigned to products and become expenses when products are sold. So let's take a look at the value chain. Value chains are the sequences of functions and activities that over the life of a product or a service will add value for the customer from research and development and design all the way through production, marketing, distribution, and customer service. The goal is to achieve a desired ROI. Now, if you'll remember back, there are some of these that, according to financial accounting, are not costs, product costs, by the strictest definition. But they have absolutely decision-making importance when it comes to the managerial side. So let's look at cost accumulation and assignment. Costs in cost accounting are accumulated and recorded as cost pools. Categories of costs, and then those costs will be assigned to various cost objects, such as products, jobs, or services. Direct costs are really easy and very convenient to trace to products or units. These are things that we would not have as a cost if that product or activity was discontinued. So, for example, the raw materials that go into creating something. If we didn't create that, we wouldn't need those raw materials. Indirect costs, though, are not easily or conveniently traced to a unit, product, or a cost object. They would be incurred regardless if that product or activity was discontinued. Now, costs for cost accounting purposes, little bit different depending on whether you're a merchandiser or a manufacturer. Because merchandisers really just buy and sell finished goods, whereas manufacturers buy raw materials to produce a finished good that they manufacture and sell. Product costs for a merchandiser are reported in the current assets on the balance sheet in the merchandise inventory, along with other current assets such as your cash, receivables, and your prepaid expenses. Whereas components of product costs for a manufacturer also reported in the current assets on the balance sheet, but they are represented in 3 different inventory accounts. One is raw materials, the other is your work in process, and the final one is your finished goods inventory. A merchandiser purchases products that are recorded on the balance sheet in the inventory until they're sold to the customer. They're already a finished product. Whereas when a manufacturer purchases raw materials, these are ingredients. They then add things such as human effort, machine support, and they take those raw material ingredients and they convert them into a whole nother different product. The finished products are recorded on the balance sheet until sold to those customers. Product costs include those raw materials or direct materials, direct labor, and then manufacturing overhead. So let's look at raw material or product costs in relationship to making a car. Raw materials are the basic ingredients of the product. So they're a radio that is installed in an automobile. Direct labor is the effort provided by workers who are directly involved with the manufacture of the product. So, for example, this could be the wages paid to actual automobile assembly workers. And then those indirect costs are components of manufacturing overhead. And these could include things like the wages of the maintenance workers, the janitors, security, guards, production supervisor salaries, the utilities, property taxes, insurance, and depreciation for the factories, buildings, and equipments. Costs that are included in an inventory are those that are identified as product costs. Product costs, direct materials, direct labor, and manufacturing overhead are included in the inventory accounts. When we purchase materials, it goes to raw materials. As those raw materials enter the process of conversion, and we add to them direct labor and elements of manufacturing overhead, they are work in process until the point in which they become a finished good. And then the sum of all of those 3 are then converted over to the finished goods inventory, which is what is used to assign the costs of goods sold on the income statement. Selling and administrative costs are not related to production activity. Those are what we call period costs or period expenses. Cost accounting systems provide information that supports successful decision making. Cost accounting information is used in determining things such as unit manufacturing costs, planning and control functions, assessing efficiency and effectiveness of operations, and providing products or services to customers. All of the information that we use in a cost accounting system comes from the basic accounting information system. Remember, those product costs, those costs that are allocated to the products, are then associated with the cost of goods sold that you recognize from the traditional financial accounting in the income statement. Cost accounting systems trace the raw materials and the direct labor to each job, and then they apply manufacturing overhead to those jobs using what's called a predetermined overhead rate. That's going to be based off some management assumptions that are made. The predetermined overhead rate, shortened as POHR, is used to apply the overhead to the jobs and is determined before the period even begins. Ideally, the allocation base is going to be a cost driver that causes overhead. So to calculate predetermined overhead rate, we take the estimated total manufacturing overhead costs for the period, and we divide that by the estimated total manufacturing units to come up with a per unit predetermined overhead rate. Overhead is then applied based on these estimates that were determined before the period begins. And it is applied based on whatever the actual activity measure is for that specific period. So we take the actual quantity of the cost driver. So something like units produced, direct labor hours, machine hours, whatever it is, and we multiply that by the predetermined overhead rate to determine how much manufacturing overhead to allocate. We're going to use Cruisers Incorporated, who applies their overhead based on direct labor hours. The total estimated overhead for the year is $4,200,000. They estimate that there will be 300,000 direct labor hours. What is Cruisers' predetermined overhead rate? When we divide 4.2 million by 300,000, we get a predetermined overhead rate of $14 per direct labor hour. So for every direct labor hour that is worked on a specific job, $14 of factory overhead will be applied to that job. So Cruisers produced 86 sea cruisers, which are sailboats, during the month. There was a total of 20,640 labor hours that were incurred, as well as the additional costs of raw materials of $368,510 and direct labor of $330,240. So we're going to determine what is the cost per sea cruiser sailboat. We have raw materials, we add the direct labor, and then we take the 20,640 direct labor hours, we multiply that by the predetermined overhead rate of $14 per direct labor hour to give us $288,960 of overhead attributable to the 86 sea cruiser sailboats, resulting in total manufacturing costs that were incurred of $987,710 and a cost per boat of $11,485. So let's look at the basic cost flows in a product costing system. We're going to use good old-fashioned T accounts, and start with materials. So materials are purchased and recorded in the raw materials account. Direct materials are then recorded in work in process, while indirect materials are allocated to and applied as manufacturing overhead. Now we're going to add the labor costs and the applied manufacturing overhead to those cost flows. Direct and indirect labor are recorded as salaries and wages payable. Time records are used to allocate the direct and indirect labor costs as they're incurred. Direct labor is then debited or added to the work in process account. Indirect labor is then debited or added to the manufacturing overhead account and applied to the work in process account using the predetermined overhead rate. If actual and applied manufacturing overhead are not equal at the end of a year, we'll do a year-end adjustment. So now let's complete the goods, because we have a lot going on in work in process. When the goods are completed, they are moved from work in process to the finished goods inventory. When they're sold, they're then transferred to the cost of goods sold that you recall being represented on the traditional income statements. One of the things that we do create is called a schedule of costs of goods that are manufactured. And this really helps managers understand and evaluate the overall cost of manufacturing products. It is sometimes easy to lose sight of some of the smaller, what we assume are some of the smaller, more indirect things that can have actually a very large impact. We will use the following information to prepare that statement for cruisers for the month of April. Raw materials inventory on March 31st of $12,900. On April 30th of $106,250. Purchases during April of $347,860 in raw materials. Direct labor costs of $330,240 and applied manufacturing overhead of $280,960, assuming there are no work in process inventories. Now notice that the product costs are shown on the schedule. We have our direct materials there at the top, direct labor, and then the manufacturing overhead. The cost of goods manufactured during April is $987,710, which will then be transferred to finished goods inventory. Now see how we came up with the cost of raw materials used. We start with our inventory for March, we add the purchase, and that tells us that there was available for use in the month of April 474,760 raw materials. Now on April 30th, there was 106,250 still in raw materials inventory. Therefore, there was $368,510 of raw materials that were consumed. We add to that direct labor, manufacturing overhead implied, and that gives us what our manufacturing costs incurred during April were. And because there is no work in process inventory, either March 31st or April 30th, we can recognize that there is $987,710 at cost of goods manufactured during the month of April. In this illustration, the beginning and ending finished good inventory amounts are assumed values. The cost of goods manufactured is added to the beginning finished goods inventory. $243,820 was what was there to begin with. we add $987,710, and that gives us $1,231,530 of goods that are available for sale. There is $127,600 of ending finished goods inventory, arriving at a cost of goods sold of $1,103,930. The income statement is then prepared using the established financial accounting procedures. Sales and expense numbers here are assumed amounts. Recall, this is a traditional format for the income statement. This is not a contribution margin format. With costing, and for example, with job costing, costs are accumulated on a job basis. Job order costing is often used for production of large, unique, high-cost items that are built to order. These are not our mass-produced items. Many costs can be directly traced to each job. Special order printing and building construction are typical job order cost applications. Job order costing is also used in some service industries such as hospitals and law firms. Where process costing is where costs are accumulated by departments. Process costing is used for production of small, identical, low-cost items, which are mass-produced in an automated continuous process. The cost cannot be directly traced to each specific unit of product easily, and production is stated in equivalent units. Typical process cost applications, petrochemical refineries, paint manufacturers, paper mills, anything that is created in mass production. Absorption costing recognizes that direct materials, direct labor, variable, and fixed manufacturing overhead costs as product costs. Only the variable and fixed selling and administrative expenses are included in the period costs. Where underneath variable costing, this includes direct materials, direct labor, and the variable manufacturing overhead as the product costs. But the fixed manufacturing overhead is included in the period costs with the variable and fixed selling administrative expenses. These are the key differences between absorption costing and variable costing. Using absorption costing, fixed manufacturing costs are applied to the work in process inventory as manufacturing overhead product costs, but fixed manufacturing costs are recognized as a period cost along with the selling and administrative costs using variable costing. All manufacturing costs must be assigned to products to properly match revenues and costs for absorption costing. Fixed costs are not really the costs of any particular product using variable costing. Using our absorption costing, depreciation, taxes, insurance, and salaries are just as essential to products as variable costs. Whereas under variable costing, the views are that these costs are are capacity costs that will be incurred even if nothing is produced. From a variable costing viewpoint, absorption costing product costs may be misleading for decision makers. However, absorption costing views the costs as the numbers that appear on our external reports. One of the most difficult tasks in computing accurate unit costs is determining the proper amount of overhead cost that should be assigned to each job. And this has always been a challenge. I will use the term recent loosely, and in recent years, what is called the ABC or activity-based cost method came about. In ABC, we recognize that there are a lot of activities within a department that drive the overhead costs. It's not only direct labor hours. There might be a lot of other things that actually drive that. In ABC, activities are identified and costs are assigned to those specific activities. The central idea behind ABC is that products require activities and activities consume resources. Most cost drivers are related to either a volume or complexity of production. So this could be machine time, machine setups, purchase orders, production orders. These cost drivers are any variety of things that cause a resource to be consumed. 3 factors are considered in choosing a cost driver. There needs to be a causal relationship, benefits received, and reasonableness. Activity-based costing procedures include identifying the activities that consume the resources, assigning costs to cost pools for each of those activities, identifying the cost driver that is associated with each activity, and those could all be different cost drivers, computing the overhead rate for each of those cost pools. And this is basically the same formula as we use for the predetermined overhead rate, estimated overhead cost divided by estimated number of activity in units, but we only look at it in the pool costs. And then we assign costs of the products using that computed rate. So let's look at an example to really compare the traditional costing where we had, just direct labor hours as our cost driver for our predetermined overhead rate with ABC. Starting with traditional costing, cruisers manufactured their sailboats and canoes. Overhead rate is applied at the rate of $14 per direct labor hour. Production for May was 100 sailboats requiring 22,000 hours and 1,000 canoes requiring 13,000 hours. So when using the traditional model and applying our overhead to each of the products, we will apply $308,000 to the sailboats and $182,000 to the canoes. Now let's look at the activity-based costing. Activity-based costing is kind of expensive in setting it up. It does require a lot of maintenance, but it is more accurate because there is more intensity in the identification. So they identified some specific activities and costs related to their overhead rates. In the production orders, the driver there is the order itself. In hull and deck setup, the driver would be how many times do we have to set it up. For raw material acquisition, how many receipts, how many orders of materials came in. Material handling, how often did we have to move the material? Quality inspection, how many inspections occurred? And then cleanup and waste disposal. How many loads were there? So there's the same amount of total overhead that needs to be allocated. However, we're going to allocate it differently based off numerous drivers, different things that occur in the production of the items, versus the static direct labor hour predetermined overhead rate of $14. So using all this activity center data that cruisers went through, we can determine the amount of overhead applied to the two products. So how many of each activity did a product take? There were 13 orders for sailboats, 103 setups, 222 receipts, so on and so forth. Then we looked at canoes. There was 1 order, 1 setup, 10 receipts, 50 moves. We allocate the rates from that activity center chart. So for example, 13 production orders were prepared at a rate of $750 per order. So this was $9,750 applied to sailboats and only $750 applied to canoes. Carry that all the way through the rest of the table. And we now have a table complete applying overhead at the overhead rate for each unit of activity for the two different products. Let's take the amount of overhead that was allocated and let's compare that back to the traditional costing. You see here that the sailboats underneath activity-based costing are allocated a higher amount of overhead than the canoes are. This is not uncommon when you have different complexity to your items. Items that are more complex have greater overhead costs applied to them than previously realized underneath the single overhead driver.